Today we're going to talk about why stock prices change. And the simple answer is that it's just based on supply and demand. But a lot of people think that stock prices change because, there's someone at Robinhood or Fidelity kind of saying the stock price is this, and then you can choose to buy and sell. That's not really how it works. It's simply put based on supply and demand. And today I'm going to draw a quick diagram to show you guys how that works, a simple logic diagram. And then you can basically extrapolate this out to millions and hundreds of millions of people making these transactions every day. So basically, why stock prices change: supply and demand. For every buyer, there's a seller. And today I'm gonna write that out very simply for y'all. So 3 key parties: you as the buyer or seller of a stock, the broker who mostly makes money off transaction fees and interest, and then the market maker who makes money off the bid-ask spread, okay? And all these key parties are important to know because they're the ones that are involved, and especially the broker and market maker, they're the ones that always make money no matter how many buyers or sellers, no matter the stock prices, if they increase, decrease. The only people that always win out are your broker and market maker. So remember that, and that's why financial institutions have an incentive for you guys to trade, whether it's like on Robinhood, Fidelity, and keep making transactions, because they make money off the bid-ask spread, the interest payments on debt, and also transaction fees. So let's start very simply, and let's just say that you want to sell one of your stocks. So the first thing you might ask is, okay, let's say your stock, you want to sell it for $100. So you say, okay, does anyone want to buy my stock for $100? All right, so the first question you ask is, does anyone want to buy my stock for $100? And by the way, this diamond is a decision. So whenever there's a diamond, there's a decision point, right? And so for this question, well, there's really only 2 answers, obviously. Yes, there either is someone who wants to buy, or no, there is no one who wants to buy. So let's start with, okay, let's say no one wants to buy this stock. Now, the next question we might ask is, okay, well, how about for a cheaper price? How about for $99 or $99.99, or all the nines can keep going and continue into infinity, right? But let's just say, okay, how about $99? So we reduce the price. Now, again, the answer can either be yes or no. So let's say the answer is no again, right? Now, if the answer is no, we just keep reducing the price. Let's say this price is X, right? And we just reduce the price by another $1. Let's say the answer is no here. So every time the answer is no, we keep seeing if there be a willing buyer for an even cheaper price. The broker and bid-ask spread, market maker and buyer-seller, simply put, that's how these transactions work. Extrapolated to millions and millions of people doing these transactions every day. So, hey, if no one wants to buy for $99, okay, how about 98? How about 97? And then we keep going on and on. Now, let's go back to our original price and our next price. So does anyone want to buy for 100 or 99 or whatever the price is, right? What happens when there's a yes? The next question we have to ask is, okay, is there more than one buyer for that price? Now, why do we ask if there is more than one buyer for that price? Well, because if there isn't more than one buyer, then great, we can sell that stock for that price. But if there is more than one buyer, then that means there's more demand than supply. The seller can potentially raise the price and get more money off of it. So this is how the stock price might increase. So the next question the seller might ask is, okay, well, how about for this price plus 0.0001 cents or plus $1 in our case? And this is how the broker works with the buyer and seller and the market maker to instantaneously change these prices on like a nanosecond basis. So if there's more than one buyer, cool. So can we sell it for $101? If there's more than one buyer for that price, we increase the price And if there keeps being more than one buyer for that price, we can keep increasing the price until there's only one buyer. Okay, so that's how these stock prices increase, is we keep increasing it by an incremental x plus 1 or x plus 0.00001 in the case of what actually is going on in the market. So let's take a step back. First, the question we ask is, hey, does anyone want to buy the stock for $100 that we designate as? If not, then we keep reducing the price. But if there is, then hey, is there more than one buyer for that price? If there is, then we keep increasing the price until we get to just when there's no more buyers willing to buy for that price. So our final thing is, great, we found a buyer and we sell to first bidder. So if there's no one willing to pay a higher price, there's only one buyer willing, then we sell to first bidder. So let's go over this really quickly again. Okay, so the first question we ask very simply, hey, does anyone want to buy for this price? In this case, $100. If there's no, then we keep reducing the price that the seller is willing to reduce to, and keep reducing. This is how stock prices might decrease until we get a yes, right? Once we get a yes, okay, is there more than one buyer? If there's more than one buyer, then that means there's people competing to buy this stock, right? So if there is, then okay, great. How about for an increased price? This price plus $1 or this price plus 0.001 cents, right? And this keeps going on and on until there's finally a consensus on what that highest price is. And then finally, great, no, it's sold to the first bidder. This is the maximum price we're willing to pay. That's pretty much it. Now, is this an oversimplified model? Of course. But the key thing now to remember is that, hey, there's not someone necessarily inputting a price for a stock or not. It's all supply and demand. It's all matching buyers with the sellers. And the three key parties are you, the buyer, the seller. And the main thing is that who are the winners in this? Who are always the winners, no matter if there's a recession or a bull market? Well, it's going to be the broker and the market maker, right? They are always making money off transaction fees, interest, and the bid-ask spread, or the buying and selling price difference. That's why these guys constantly want us to transact, buy and sell stocks, even if it's a bad market or a good market, because they're always the ones making money. Okay, thanks for your time. Cheers.